Hey, welcome back, ladies and gentlemen, to another video. And today we're going to be going over what the futures actually are. So what the futures actually are, well, first of all, whenever you go in and you open up whatever your favorite stock trading app is, you see these over here. You see the stock futures. So either they're green, which means the market is typically going to open up, or they're red, which means that the market is going to open down. We see that the VIX right now, the futures are red on that, and they are green. Looks like across the board. So maybe we have a green day tomorrow. That's what the market is anticipating. But the question remains, what are these actually? Like what are we actually looking at here when we're looking at these futures? So basically what the futures are is a future contract. So it is basically a contract to deliver something in the future. So let's take a corn contract. Let's say that you are a farmer, you are Farmer Joe or whatever, and you want to sell your corn for a certain price and you want to reduce your risk. So let's say that the price of corn today is $60. So you want to sell your corn for, I don't know, $62, but inflation is taking off. So you think that maybe the price of corn will go up. I don't know. Maybe you think that the price will go down. I don't know. Whatever reason that you are choosing to sell your corn at a fixed price, you choose to sell it at $62, and somebody else who's willing to buy it for the $62, maybe they think that the price is going to go up more. This could be a 3-month contract, 6-month contract when we're talking about stocks, 9-month contract, or a year out. So let's say that it's a year out contract, and 1 year from now, the price of corn has gone from $60 to $70. Essentially, what's going to happen is that person could either sell the contract and they would make their profit there. They would make about an $8 profit they would make an $8 profit if they bought it for 62, were able to sell it for 70, or they could take delivery of that corn and then sell the corn, which is now worth 70, and they bought it for 62. So that's basically how a futures contract works. And when you take it into stocks, it basically is the same thing. So it's basically a contract of an underlying stock index. So this S&P 500 future and this Dow 30 future is basically traders saying that we're willing to pay more than what the underlying asset is worth now, so that we can essentially buy that future, and we think that it's going to be worth more in the future. So I've said future a lot in this video. Basically what you're doing is, let's say that we got 34,389 here on the Dow 30 futures. So let's say that we wanted to buy it for, I don't know, 34,400 or something like that. So we basically set up the contract. We set up the contract to buy it for that much, and then it goes up to, let's say, 36,000. You made a profit right there because you can exercise that contract, and you basically you pocket the difference there. So if you think the markets are going up, you'll be willing to essentially buy that future for more. If you think the markets are going down, you will only be willing to pay less than what the index is currently worth. So that's essentially what the futures are, and that's why you see them moving before the market opens, is because people are basically, based on buying and selling activity, people are basically deciding the direction of the market through these futures. So that is what they are. Hopefully you guys got some value out of this video. Just a little short video for you today. Hope you learned something about futures. We had an interesting event at the beginning of the pandemic where the oil futures went negative. There's some great videos out there about that. Definitely recommend checking them out. Also, check out the links down below if you want to help the channel grow and you want to help me out as well. And I'll see you guys in the next video.